Hello, I'm Jim Strang. I'm the chairman of HgCapital Trust, and I would like to tell you about the results for the company for the full year to the end of December 2025. So in terms of the key highlights for the year, the net asset value return for the year was 4%, which resulted in a closing net asset value of £2.6 billion sterling. Over the course of the year, the share price return was minus 5%, just slightly less than minus 5%. So the closing year-end market capitalization was £2.3 billion sterling. In terms of the overall performance of the company, the underlying trading performance of the HgT portfolio has been very strong in 2025, with the underlying companies in the portfolio, of which there are just over 60, generating sales and profitability growth of 17% and 19% respectively, which is very much in line with our prior year's experience. And the aggregate level of profitability, the margins in the business and the EBITDA level are running at 33%, which again is very similar to what we've experienced in years gone by. In terms of our overall investment activity, we had new investments of just over £300 million, going into a number of different portfolio companies, which we'll come back and talk to later. And realizations, also like to point out that we had an incredibly strong year around realizations, particularly assets related to Intelerad and G Treasury, both of which were sold through the course of the year at significant uplifts to their prior carrying values. So in the case of G Treasury, 97% above the carrying value, and in case of Intelerad, 62% above the carrying value. So we've had great outcomes on realizations, well in excess of the carrying value that we held the assets at. In terms of the overall balance sheet of the company, at the end of the year, we had liquid resources of £368 million sterling, and that includes the revolving credit facility, which is £375 million that we've had in place for a number of years now. And our outstanding commitments at the end of the year, which is effectively the promises we make to HG for future investments over the next investment cycle, are £2.2 billion, which that sum will be drawn over the next 4, 5, 6 years into the investment program as the cycle of investments completes in its usual way. So in terms of what drove the portfolio performance across the assets that are held within the HgT balance sheet, effectively portfolio performance comes from organic and inorganic growth. So the organic growth is the underlying profitability increases of the companies that are within the portfolio. And that is obviously driven by the volume of business that they transact and the value or the pricing that they're able to achieve on the volumes that they create. And over the course of the year, we ended up with around about half the aggregate level of EBITDA, which is coming from that organic side of the portfolio. So a combination of increasing the volumes, which is either selling more products to existing customers or indeed expanding the customer perimeter to new customers and adding new products to the portfolio. These factors multiply together effectively to drive volume growth. And then in terms of what drives value, then clearly the more we can bundle solutions, and this is something that HG does a lot of in its portfolio, the more you can bundle solutions, the more you can optimize the value that you create. And so these two factors combined drive the organic side of that overall growth number. And then in addition, what the portfolio is designed for is to be able to increase its overall level of growth by building relative scale through buying other businesses. So effectively what HG does when they're looking at assets is try and identify areas where there's a degree of fragmentation. And so they can develop an exposure to a larger business inside a vertical and then look to grow its scale even further through a series of acquisitions. And the greatest example of that is Visma, which is the biggest investment in the company and which has gone through something like 400 acquisitions over its ownership period. And indeed, around about half the overall EBITDA growth comes from that inorganic expansion. And those two factors combined help drive the dynamic. I think what is obviously very evident and to all of us is the impact of AI in the world that we operate and indeed in technology businesses in general. And I'd say that so far, the actual impacts of that have been limited. And indeed, HG has been very forward-thinking and forward-leaning in trying to create opportunities from that AI revolution, if like, for want of a better word. And we're already seeing the benefits of that in our portfolio. So I think I would say, looking back at the year gone by, a pretty strong year in terms of business performance, but equally a pretty evolutionary one in terms of how it's being created. And I think we're seeing the benefits of that AI transformation in pounds, shillings, and pence across the portfolio, which is really heartening. So evidently, the public markets are viewing software companies in general with a reasonable degree of skepticism in the last few months, with valuations moving around very significantly and significant declines in share prices. And I would say the way to interpret that from the HgT perspective is that the public market valuation movements are obviously important inputs into our overall valuation approach and model, but they are not the only input. So the way that the valuations are actually created, they're driven by a combination of relevant public market companies, and those with an emphasis on the word relevant, and then also the private market comparables that we use in the overall basket that we use to determine the individual value of a company. And this is an approach that we've implemented for many years. We haven't changed it at all. But what it tends to do is it means that very volatile movements in the public markets tend to be far less evident in the portfolio valuations of the company because we have this weighting effect. So we have a number of companies that go into the public basket, so often 10 to 15, plus around the same number of trading comparables from the M&A markets. So if you multiply all these things together, you tend to have a very damped effect, both on the way down and on the way up. And that's what you see in the valuations that are attached to the report for the year. And indeed, that's why they are, I guess, more resilient than you might believe if you looked at the public market valuation movements. So over the course of the year, we obviously had a significant amount of new investments, so 357 million, and also exits of 215 million of realization proceeds. And as I noted earlier, the two most notable amongst those exits are Intelerad and G Treasury, both of which were sold at very significant uplifts to their carrying values. And I think what's heartening around that is both of those assets, companies were acquired by strategic buyers. So, if you like, the most sophisticated buyers have valued these companies in the way that they have. And indeed, they both benefited from, I think, very thoughtful work from HG in positioning those businesses for the future, because clearly anybody that's buying the business doesn't really care about what happened last year. It cares about what's going to happen in the years to come while they own them. And so the idea that these very experienced trade buyers and household names were able to transact and indeed to value those companies where they did was really very heartening, and it gave the board a great deal of comfort around the machine that HG is operating. To be clear, the valuation uplifts were very exceptional, and I think what that demonstrated was the scarcity of the asset, which in both cases they were very much must-haves. If the buyers hadn't bought those assets, they would have struggled to have found a better alternative. And so the idea of creating something that's really truly strategically valuable to a strategic buyer, not an easy thing to do, but a couple of great case studies of why. And I think it was, again, in some ways, it's a problem for our valuation approach, because as you might imagine, an uplift of that magnitude does beg the question, were you marking these assets appropriately beforehand? And I think the way I would rationalize that is that these were exceptional bids. These companies were both sold probably a couple of years ahead of when they would have been in the normal course of business, and that reflected the scarcity value and the fact that the buyers were just very, very keen to transact and to buy the assets. I think more broadly, in terms of exit dynamics going forward, clearly we're in a very disrupted period with all the geopolitical risk and uncertainty, as well as all the AI uncertainty that's out there. I think in terms of the company, we understand that, and that will have an impact on the absolute number of realizations that we're able to deliver in the next 3-6 months. But the medium-term forecasts are very much intact, and indeed, even now, there are the businesses in the portfolio being approached by buyers, somewhat unexpectedly, but they're being approached. So I think our overall confidence in the cash flow profile of returns that we're going to be able to create at the HgT level is actually reasonably good. And the board feels confident around that in the medium term. And indeed, if we weren't confident around that in the medium term, we wouldn't have been going through the commitment program, which we completed in the year, which is important to drive the long-term value of the company in the years to come. Well, thank you very much for taking the time to look at the video today and to hear the highlights for the financial year. If you'd like to learn more about the company and its results, then please go to the HgCapital website, where there is a full suite of information around the results for the year, and indeed a lot more information around the company and the activities of HG, who are the manager.